When launching a company or investing in one, it's easy to get carried away by the next cool thing that's going to light your consumers with delight. But did you know that all of that can go up in flames if you don't have the right legal work in place? So getting legal foundations in place while delighting your investors are all critical skills we need in our pursuit of making billions. Let's get into it. Hey, welcome to another episode of Making Billions. I'm your host, Ryan Miller, and today I have my dear friend, David Siegel. David is a partner at Grellis Shaw. His law practice is focused on supporting entrepreneurs from pre-seed to pre-IPO. David has advised startups in raising well in excess of $1 billion in funding. He has written or appeared in outlets including Entrepreneur, CFO Magazine, and more. So what this means is David is the guy you call to help you with contracts, compliance, and term sheets for your startup. So David, welcome to the show, man.
Thank you so much for having me. I'm very glad to have gotten acquainted with your podcast. You know, I'm kind of in a bubble in the world that I live in. I get to talk to a lot of founders. I get to talk to a lot of pure tech investors, but not only do I get to hear a different perspective, but I get to hear about people investing in all sorts of things that are just not pure tech world. So I learn a lot, and that's one of my favorite parts of my job. So it's nice to have outlets outside of my job for that as well. So thank you.
Yeah, well, it's good to have you. You know, I've been impressed with everything you've done and all the work that you've put in building your career and supporting entrepreneurs from the beginning almost to the exit. So this is good. We're gonna get into a lot of good stuff. But before we do, maybe you can walk us through, like, how did you get started in this industry? How did you become an expert in contracts and all things startup on the legal side?
Yeah, so I mean, I've been practicing law for 20 years. You know, I was in New York. I graduated NYU Law School, and startup world was not where I thought I was going, and it's not where I went. I thought I wanted to be a litigator and be in court all the time, so I went to a big international law firm and worked for several years on big teams on, multi-billion-dollar litigation cases that, types of things that were in the news, which was exciting and challenging, but not quite the fit for me. I kind of learned two things about myself. One, I want to help people build things, which is not what litigators do. That's not a knock on litigators. They do something very important, but they're not building up. They're protecting and the like. They're fighting. And the other thing is, as a person, my role that I like to have with people is kind of, people call me a consigliere. I'm somebody's trusted advisor. I'm the person, and I am on calls very frequently at 9, 10 o'clock at night because clients call me to talk about whatever is on their mind. And that's not a litigator role. That's a corporate role. And the other thing is technology. I've always been working in IP, so technology is always of interest to me. So it's kind of a natural fit. So I moved out to California. I found the firm that I'm at now, and I've been working here for 12 years already, and have had a great opportunity to work largely with founders and entrepreneurs, but also with investors, helping them grow companies. And it's been a wild ride and a changing ride over time, of course, as I'm sure you can imagine.
Man, well, yeah, what a wild ride. So 20 years, 12 years at this current firm. You've been busy. So now that you've been there and your practice has been built up and you've built a pretty impressive background and reputation for yourself, maybe you can walk us through, some of the good stuff that you're up to today and some of the people that you've helped.
One thing I've learned over the years is in the legal world, change is not quick. Lawyers aren't often open to change. So there are very few people who are good at the transition from, say, being a litigator to being more of a corporate person. And I was fortunate enough to be able to make that change. But it's really helped me in terms of helping clients that corporate lawyers don't typically know. They structure transactions, they write contracts, they negotiate contracts, but they don't know what happens to this stuff later. That's when the litigator comes in. That's something that I know because I've done it. And I was thinking pretty recently, I do a lot of M&A work and I negotiate M&A transactions. And that's at the LOI term sheet level, like the high level negotiating. And it's also the 100-page merger agreements, making sure everything is the way the client wants it. And it's something that a lot of people don't focus on. But pretty recently, I had a transaction. We actually took over post-term sheet. They moved over from another firm, which happens. I was dealing with a dominant founder at the time, and he was concerned about a very particular issue, which is a real issue about liability. If you're a private company selling off to a buyer, you're going to be making reps and warranties and indemnifying the buyer for all sorts of things. And this founder had a friend who got screwed because they had post-acquisition, the buyer, got sued for patent infringement because of something to do with the seller's IP. It was not a meritorious case. The buyer litigated the case, won. Something like $11 million in legal fees were spent by the buyer, and the seller stockholders had to pay that $11 million in legal fees, even though in reality, the seller's IP didn't infringe. And they tried to negotiate, and my client tried to negotiate this away, that right away at the term sheet phase, and got shot down. But the reality is, and I've noticed this since then over and over, a lot of corporate lawyers, big firm corporate lawyers, don't understand indemnification provisions and how the actual words are interpreted. I was able to make literally a 2-word change in the merger agreement. The buyer always drafts. It went over, nobody noticed it because they don't know what these words really mean in court. Solved the whole problem, never debated again. Now, it hasn't been that long. I don't know if this client's buyer will get sued, but this client is protected. And I'm telling you, that's millions and millions of dollars that you can save.
Wow, that is phenomenal. So, you remind me of the old schoolyard chant, sticks and stones can break my bones, but words can never hurt me. But in this case, with David on the case, the wrong words can hurt you, but the right words can certainly save you. Look, like 2-word change. That is the world that we live in. And so whether you're a startup or a fund manager, your contracts matter. And I would argue lightly that not only do contracts matter, but the person that you're seeking to work with to write those contracts matter. And so working with David or anyone in this industry, I know a lot of people are like, well, I don't know, my brother's family law or something like that. No. Don't do that. I know when you're entrepreneurs, you're starting out, if you're an emerging fund manager, you want to save money, don't save it here. Save it somewhere else. Work with somebody. I'm not saying, spend all your money on legal, but I am saying don't cheap out because you can get what you pay for. And so with David, who's built a phenomenal reputation in this industry, working with founders, working with him can actually save your behind. Now, I'm not saying this isn't an infomercial. I'm just drawing the illusion here that it's important to work with people who are competent, who know this industry, and in fact, know exactly, like you said, these little wordings, these 2-word things. I know what those mean in court. These are very subtle, but very it's an ace up the sleeve. And I know what will protect my clients. This is what I'm hearing. So working with you can certainly save a lot of problems for you, but also your investors. Would you agree?
I fully agree with that. When you're looking for legal help, I agree. Don't go to someone who does everything. There are people who specialize in these areas, and that's who you need. You need people who know the issues and know the market as well. From an entrepreneur perspective, I hate to say it, you don't want to go to the lawyers who represent your investors because you're I hate to say it at the beginning, you're a small fry. You're not their billables. The investors are. The investors are repeat business. And there are subtle ways in which that will impact the advice you get. From an investor perspective, I say the opposite. You get your claws into a company, try to get them to go to a firm that you have a good relationship with. The lawyers are not going to screw the company, but it'll be, in little ways, at least in your favor. And a lot of entrepreneurs will listen if you tell them, hey, go to this great law firm. It doesn't have to be the exact law firm you used for, the deal.
Okay. So if you're a founder, get your own counsel. If you're an investor on the other side of the transaction, try to fold them in and use your counsel where you have a relationship. Thank you for providing both sides of that same coin. I really appreciate it. Right. And again, it's not because there's anything illegal or shady going on. We're just saying relationships wise, relationships matter. On this show, we understand reputation relationships really do matter. And so leveraging your relationships on your deals, that matters as well, or separating from other things. So I think David is giving us just a perspective from someone in the business of saying, depending on who you are, here's a good strategy. And that's why people like yourself and many of our listeners come. Now, you mentioned that you deal with a lot of people from pre-seed to pre-IPO. When it comes to, say, pre-seed to A, I know convertibles are a pretty important vehicle in completing that deal. So on a pre-seed to A-ish range, convertibles, maybe you can walk us through just the basic stuff. What are convertibles and why should investors in early stages consider using them? Yeah,
and this is, a lot of this is an alignment between founders and investors, the use of convertibles. So there are different instruments, the 2 big ones being convertible notes and something called safes that are used so that investors can, frankly, just quickly put money into a company without a lot of legal fees and without a lot of negotiation. The idea being that a full-on Series A equity round involves a lot of legal documentation, a lot of terms that have to be negotiated. And by using these convertible instruments, money's put into the company with a promise to convert it into equity later, and you defer those negotiations until, say, Series A or whatever it happens to be. With a convertible note, which used to be more traditional, but is, I wouldn't say fallen out of favor, but it's not as common, at least in major tech areas. It's a note. It's debt that an investor will hold in the company. It has interest. It has a maturity date, but it has a feature where under certain circumstances, it will convert into equity based on some sort of formula. A safe is actually much simpler. There's no debt. There's no interest. There's no maturity. It's just an agreement to convert into equity at the next equity round based on some sort of formula. Of course, the devil's in the details, and this is where investors and founders will diverge in interest. And some of this is really kind of tradition because these documents can be varied in infinite ways, right? But the typical safe nowadays is referred to as a post-money safe. And without getting into the complications of it, basically its feature is that all of the dilution that is experienced by raising more and more safes until a conversion round falls on the founders. While a typical convertible note or the older pre-money safes that exist, that dilution is shared. So if you're an investor, if you're going to do a safe, go to the YC website, pull off a post-money valuation cap safe or valuation cap and discount safe and use that. And that's going to give you a lot of protection. If you're a founder and you have the negotiating leverage, try to get a pre-money safe. Convertible notes have pluses and minuses for founders and investors. They can be more beneficial to investors. Of course, they could be written in that post-money way. It's just not traditional. It's odd that there are just these standards that have developed in the tech ecosystem. It can be somewhat hard to get around them. But if you're a founder and you're stuck with a post-money safe, it's really okay. The big thing I would say for founders dealing with post-money safes is when you think about the valuation cap, there's a valuation on these safes usually, and that's the way it's determined how it'll convert. Don't get stuck talking about what you think the company is worth now at the moment you're raising this safe. You want to talk about the projected valuation at the time the safe will convert. That is what can protect you from some of the dilution. Of course, if you're an investor, don't fall for that argument.
Got it. And thank you for that. That's brilliantly said. So why would you say control should be the primary focus at this stage?
So taking a step back, when I look at the negotiations between an entrepreneur and a VC, the VC has an advantage of being a repeat player in the way the entrepreneur often isn't. VCs negotiate deals all the time, and so they have a lot of familiarity, and the founder doesn't. And then the VC has the money, so that's automatic negotiating leverage. So there's a tendency for founders in the ecosystem to encourage founders to kind of negotiate against themselves from day one. So you set up a company with no protections for the founders, and VCs in these simple incorporation documents, even from the largest law firms, you spend $1,000 or more an hour on partners and you're getting the most simple documents that you can get off of some online resource. And then you do a VC round and suddenly you have these larded up corporate documents with dozens and dozens and dozens of pages of protections for your investor. It doesn't have to be that way. You can set things in place. You have control at the beginning. So set the stage at the very beginning when you can to, at a minimum, signal to your investors that you care about this. And one simple thing that founders can do, or at least consider, it's not for every founder, but you can create 2 classes at least of common stock at the beginning. Create a super voting class, say. The message in the industry is don't do that. Investors will make you get rid of it. So who cares? That's no extra money or time to do that. And the reality is, at an absolute minimum, you're forcing your investor when you're negotiating to ask you to do something. And whenever they ask you to do something, you can ask for something. Maybe you won't get it, but it really has worked. I've seen it survive VC rounds quite a number of times, and there are arguments to make that work. But also just negotiating for something else. I had a client a couple of years ago whose company has since been sold off, but they negotiated what they wanted is the ability to force the investors to go along with any sale if the investors get a 3x return. They didn't know if they were going to shoot the moon or not, and they were getting very prominent investors, and they didn't want to get stuck. And the investors went along with this. Get rid of Class B. We'll give you this. We'll give you this thing that is not a standard get. And it worked out. They had like a 4x return on their sale. It was not a shoot the moon company. It just didn't go that way. And so they were able to take advantage of it. At the beginning, when you have the ability to set things up any way you want, at least consider trying. Don't pre-negotiate the simplest thing in the world to make yourself the most attractive company for a VC, particularly because attractive for a VC in this sense is just giving up everything on day one.
Man, well said, my man. So just making sure that those documents are in place. I like what you said of saying, make them ask you, because that is also an opportunity. If they ask, you get an ask. And so having those super voting shares that you alluded to, or some type of way of just saying, how do we maintain control for as long as possible, if not indefinitely? But a lot of these things, whether you force on a sale at a certain rate or any other issue, when you're in the early stage, don't just think about who gets what as far as profits or participation, sometimes we call, but also the control. And so covering both the participation rights and the control are a great place to start. Brilliantly said. Moving forward, not everybody's in pre-seed to Series A. Some people are in their growth phase or Series B, Series C, around that range. So now we're going to talk about a little bit of the opposite of a little bit of losing control, particularly on the board. So a lot of times you start to see some interesting things start to trickle in around the board at this phase in a company. When they're in growth phase, there's a lot of change going on, emotions, egos, There's all kinds of stuff. This is real talk. And so in that time, if you're a founder or an investor in a company like this, probably have a board, which very fundamentally is just a bunch of people that represent the shareholders, or at least they should be. And what does that mean when you're at this phase, whether you're in a fund, you have a board, whether you're in a startup or any company, you're on a board? What does it mean to lose board control at this phase? And how can startup companies maintain control while still pleasing their investors?
Yeah, I mean, this is one of those areas where it's treated, I mean, it is a zero-sum game, but you can be somewhat more creative about how to give everybody some of what they want. From the founder perspective, yes, as soon as you start having real investors in equity rounds, your investors are going to most likely want board representation. For a company perspective, that's usually actually a good thing. I will say from a founder perspective, at the early stages, a common ask from the investors is they'll say, hey, let's have a 3-member board, 2 common, 1 preferred, but one of the common is going to have to be whoever the CEO is at that moment. And that is the slippery slope towards founders losing control of the board. So as a founder, you want to be careful about that, because if you, for whatever reason, cease to be CEO, then it's a black box who's going to be in that seat going forward. But as things go later on, it's often the case that there'll be 1 or more investors, and then maybe even they'll want an independent board member. And there's a concern, a lot of times investors say, okay, so we'll have 2 investor members and 1 independent and 1 or 2 common, and you're going to be saying as a founder, hey, I want a majority of the board, so I want 4 common. Investors will say that's too big a board. And a lot of people just don't know that you can have a board seat with multiple votes. So you can have control over the board with 1 person in that controlling seat. I wouldn't say it's common, but I've certainly done it. So it's a tool to keep in mind. From an investor perspective, you don't necessarily have to have the most board seats to get what you want as a preferred board member. One thing you can have are preferred board veto rights. You can have a set of major things that require preferred board approval to do. And that way, at least you won't have common board members. Even if they control the board, they won't be able to do anything on their own. The major things would require your say-so. You always have to think when you're thinking control, there's offensive control. I call it offensive control and defensive control, right? Offensive control is the ability to make something happen, and the defensive control is like a veto right. I think investors' best arguments, usually, until they're a majority, is for veto rights as opposed to offensive control and being able to take over the company. When they're in a majority, then it's a different story. But there are ways to kind of give everyone at least some of what they want, which is often the right solution, though not always.
So how do you roll out the mechanics on that? Is it just through like shares, or how do you get like control the board with 1 seat? What mechanically, from a legal perspective, how do you set that up? Is it
assuming
a share thing?
No, it's actually not. It's assuming you're the standard issue Delaware corporation. It's your certificate of incorporation has to say there's this 1 board seat that gets X number of votes. And that's where it's housed. It's not done through shares.
Okay. So in your articles, great. And then, with that, how can business owners use their budgets just to work with the board, represent regulatory issues? Like, what have you seen? Yeah,
I mean, and it's important. It's important. All spend, obviously, in growth stage, all spend is important. You want to spend money on legal wisely. I've seen it used too little and too much to ill effect more often than I'd like to say. But what I would say is, first thing first, I'm assuming here you're not in healthcare. You're not in a regulated industry. If you're in a seriously regulated industry, you have to expect to spend a lot of money on legal and have somebody in-house probably pretty early. That's just the way life is. Standard issue, A, B, post A, B, C stage company, but for you have in-house counsel. I like to talk in the $50,000 to $100,000 for getting through a year of routine-ish legal, particularly for enterprise where you're negotiating a lot of contracts and the like. If you're a consumer, it's a little different and the costs go up more later than at the beginning. But if you're particularly in the enterprise world, I would say 50 to 100,000. And that doesn't include investment rounds. A real investment round, your Series B, your Series C are going to cost extra money. The rule of thumb I like with that is usually your investors are going to want to have you reimburse them for their legal fees for the round. I tell clients budget 1.5x what the investor asked for. And the reason is twofold. One, the company incurs more costs than the investor. They do the initial drafts. They have to do all the filings. There's just a lot more work on the company side. But the other thing is the amount the investor asks is a signal about how hard they're going to drive you in the round. So if an investor is asking for $30K at a Series B, it's not going to be that huge a deal. But I would budget 45. But if the investor is asking for 100,000, well, then I'd seriously think about the investor. But I would expect to spend a lot of money on that round.
Okay, perfect. So 1.5x times what the investors ask for. But rule of thumb, as I say, thumb to the sun estimate around 50 to 100,000. If you're in the B2C range or you're in a growth company, that's about what you should budget just to address regulatory issues. This is good. This is tactical stuff that people can do. And finally, a third thing, we got to get the 3 things. Late stage IPO. When's the right time to introduce liquidity programs? Is it this stage or others?
Well, formal liquidity programs, usually you want to wait until late stage because there's cost to it. It's usually not worth it in a formal sense at earlier stages. I'll mention something about earlier stage stages in a minute. But when you're at the later stages, it's a good time because you're going to have to do something like probably a tender offer, which is a formal system where you have to make disclosures and you have to keep offers open for a certain period of time. You might have to file things. It's not a cheap process. And by the way, as I said, disclosure. So you're giving out financials and things like that early stage companies, even under an NDA, don't like doing. So this is a good time to do it. It has to be done correctly or you can get sued. And you can get sued in a lot of ways. There's a lot of regulation around this because, as I said, if done correctly, you have to do certain types of disclosures and the like. But also at the same time, let's say it's a company buyback is the form of a liquidity event. There's potential liability. Are you going to do a company buyback right before the company's going to file for an IPO? No. Right before the company is going to be sold off? No. It's depending on what's going on, the major events in the company that might be secret. You can't even do one of these events, or you have to at least check with counsel before you do. Companies deal with employee transfers of equity in different ways. Some have blanket transfer restrictions, say no one can sell without board consent. Some rely on a right of first refusal on the part of the company, which is great and all. But let's say you've gotten an LOI for an acquisition and you have some employees who want to sell their stock and find some buyer and you really don't want them to sell to that buyer. Can you as a company exercise that right of first refusal? It's kind of hard, right? Because this acquisition is going to happen and you don't want to get sued. From a company perspective, the right of first refusal isn't necessarily enough. The other thing to keep in mind in the late stages is if too many people are selling off their stock to other people, you could end up with investors you don't want, A. And B, let's say some early stage employees have 100,000 shares and they sell to 10 or 15 different people. You could end up going over a threshold where your private company suddenly has to become an SEC reporting company and have all that expense and administrative hassle of very much like a public company before an IPO. That's something you want to avoid. That's, blanket transfer restrictions probably are the best way to avoid that. Okay. Even though I do sympathize with employees who hate them. So I kind of go both ways there. From an investor perspective, I definitely would push for blanket transfer restrictions. All
right, great. So if you're an investor, blanket transfer restrictions, throw them in there.
Not for yourself. You can usually market not for investors, just for
everybody else but me is restricted.
Everybody else but me. But I did want to say, the moment to think about liquidity is not post Series C or D. The moment to think about liquidity is day one. It absolutely, as a founder, day one, because the way you structure your company impacts your ability to get liquidity. You as a founder, let's say Series B, you won't still own 30, 40% of the company. You want to sell off, 10% of your holdings to take some cash off the table. You can set up your company in a way to make that much more tax efficient, but that has to be done at day one. And for everyone, there are tax rules, QSBS being, the big one, where you can deduct up to 10 million of your gains, or depending on how things structured, maybe more, if you set your company up correctly and maintain it the right way. But that's not something you can do 3 years in. That's something you do on day one. So control is important, but I should mention liquidity is the other thing. I mean, money matters. I mean, most people want to make money and don't want to pay as much taxes.
Yeah, fair point.
Most people.
Yeah, myself included. So final question on this late stage IPO stage. In your opinion, what are some of the most important securities laws issues during this late stage that people should focus on?
Yeah, where I see people trip up, where I see companies trip up is not having blackout periods. So ending up in situations where they're stuck. Either they actually buy back employee stock or they can't buy back employee stock because they don't have blackout periods when employees can't sell. Or they open up sales and end up without speaking to lawyers and end up either with a situation where there are restrictions on sales of private securities and without being a public company, and they run into foul of those rules. Or, as I said, the tender offer rules. If they're going to do it correctly, they otherwise violate tender offer rules and it happens all the time. You can have a class action against you with a class of employees suing you for SEC violation.
Perfect. So as we wrap things up, is there any other last comments, anything else at all that you would like our listeners to know, maybe how to contact you, anything at all?
Yeah, I mean, in terms of what to know, the big thing is legal stuff does matter. It matters at the beginning. It matters throughout. It's not something to spend excess money on. I realize it's not the first thing people want to spend money on. So it's something you should budget for and ask for estimates and the like. But particularly as a founder, it's your chance to have somebody who's on your side who is the repeat player in the market. The investors don't need that side. The investors don't need, but the founders do. In terms of reaching me, our website is www.grellis.com, GRELLAS. I'm on LinkedIn. The firm's on LinkedIn. My email's on the website, but it's dsiegel@grellis.com, DSIEGEL@grellis.com. If anyone has questions, I'm happy to do, initial consultations. I don't charge for generally, and for anybody coming from the show, certainly won't. So I'm happy to give advice. I like to talk. I'm not just doing it here. I like to think I have useful things to say and I like to impart knowledge. So I'm in the right industry for that.
Well, that's absolutely perfect, man. You're a fun guy. And coming from an attorney who has been told to charge more, not really something too many attorneys hear, but certainly appreciate that. So, as we wrap things up, just learn about safes, convertibles, and control when you're starting out, whether you're a fund or fund manager, both of those matter. And also when you're building your legal documents or a company or negotiations, whatever it is, if you're really in that foundational stage or you want to address the foundation of an investment, talk about the board and the control of the board and how is that treated and really master that. Budget for legal. Make sure that's priced in. Have a healthy budget. David said, 50 to 100K on a standard year. If you're fundraising, you want to go a little bit more. And then ultimately, if it hasn't been obvious, I'll say it right now, work with experienced attorneys. It's better to work with someone 2 inches wide and 100 miles deep than someone who's 100 miles wide and 2 inches deep. You do these things and you too will be well on your way in your pursuit of making billions.